A huge financial anchor worth $3 billion is rapidly dissolving. When this essential structure falters, the whole world feels the shock. What does this development mean for the United States, China, and you personally? Today, we are taking a close look at one of the biggest changes in recent financial history. You will grasp why a massive portion of U.S. government borrowing is losing its steady support. What is the real story behind these shifting values? How might this affect global money markets and potentially impact everyday people all over the planet? You will uncover details that are not widely known. We'll look at how foreign ownership of U.S. government debt has quietly changed in 2025, how one of the world's largest holders has dropped from its former ranking, and what that change tells us about security, confidence, and the future of worldwide finance. We will also explain the forces, economic, political, and strategic, that are driving this reduction and why the U.S. might be reaching out to its biggest rival for support. Just a hint, it is about more than just figures. It involves trust, power dynamics, and evolving financial partnerships. Stick with me until the very end, because by the last moment, you will understand why this situation is far more significant than simple debt figures. It is an alert, a turning point, and perhaps a glimpse of what lies ahead. Welcome to our channel. If you're interested in more detailed examinations like this, please hit the subscribe button and click the notification bell. Scott Bessent began his term in early 2025 as the 79th Secretary of the Treasury. Before this role, he spent decades involved in international finance, running hedge funds, advising major investors, and traveling to many countries. As Treasury Secretary, Bessent now oversees the entire financial apparatus of the U.S. government. His responsibility is to guide the national economy, manage federal debt, and protect the financial system from worldwide disturbances and financial threats. When we talk about a Treasury Lifeline, we are referring to something immense. The lifeline is the vast network of debt and the flow of money in the bond market that supports the U.S. economy. The U.S. issues government debt, such as Treasury bonds and notes, to raise funds. Foreign governments, central banks, and international investors often purchase these treasuries. Their purchases provide the U.S. government with the money it needs to operate, pay off obligations, and fund public spending. In return, buyers receive a relatively secure investment guaranteed by the world's largest economy. This involvement from foreign parties, particularly the large international players, keeps demand high. That helps to keep interest rates lower and maintain strong confidence in U.S. debt. Historically, China has been one of the biggest foreign purchasers of U.S. government debt. For many years, it owned well over $1 trillion in U.S. debt. That established China as a crucial stabilizer in the global U.S. debt market, a key support for the flow of money into U.S. government securities. However, over the years, China has slowly reduced its holdings. As of early 2025, its ownership dropped to about $750 billion. Meanwhile, other foreign buyers from various nations, funds, or financial centers have partially filled the gap left by China. This change is important. When a major buyer like China decreases its holdings, the reliability of the lifeline weakens. Less demand means the U.S. must find other buyers to sustain its debt market. For Bessent and his Treasury team, managing this transition, finding new buyers, balancing supply and demand, and managing interest rates becomes a complex strategic issue. In this scenario, Scott Bessent's role is critical. He is not just managing numbers, he must navigate evolving global partnerships, changing investor behavior, and economic uncertainty. Treasuries are no longer simply about paying bills, they reflect worldwide confidence in U.S. debt. And when that confidence changes, the effects spread far beyond Washington, D.C. Recent data shows a significant reduction in China's ownership of U.S. treasuries. At its peak, China held over $1.3 trillion in U.S. government debt. In 2025, those holdings have fallen to roughly $760 billion. In fact, by July 2025, China reportedly lowered its holdings to about $730 billion, the lowest figure since 2009. This decrease has happened even as the total foreign ownership of U.S. treasuries has reached record levels. Put differently, While other foreign investors, companies, central banks, or funds are still purchasing some U.S. debt, China is withdrawing. The effects of this change are substantial. First, fewer purchases from a major buyer mean less demand for U.S. debt. When demand lessens, bond prices generally fall, which increases the returns for the U.S. government. That means higher costs for borrowing whenever it issues new debt or refinances existing debt. But the consequences do not stop there. Since U.S. Treasury returns serve as a benchmark, rising returns tend to push up interest rates throughout the economy. That can lead to higher rates for home loans, more expensive borrowing for companies, and increased credit costs for consumers. Beyond the technical financial aspects, there is another concern: confidence. U.S. Treasuries have long been seen as a secure option, a rock-solid investment that supports worldwide trust in the U.S. dollar and U.S. debt. When a large holder like China consistently pulls back, that perception is damaged. If investors start to doubt whether treasuries remain a safe anchor, many may look for alternatives in other currencies, gold, or other government bonds. In this sense, this reduction is not just a shrinking figure on a spreadsheet. It signals changing global priorities, a new evaluation of risk, and a less certain base for U.S. debt. For officials and investors alike, the situation has quietly begun to shift, and the consequences could extend well past Wall Street. In early 2025, Scott Bessent, the U.S. Treasury Secretary, had a high-level discussion with He Lifeng, Vice Premier of China, to talk about the delicate economic and trade connections between their nations. During that call, they addressed serious subjects: trade imbalances, import taxes, economic pressure, and the overall state of the two countries' economic relations. The tone of those talks was serious. On the U.S. side, Bessent expressed worries not only about trade restrictions, but also about global economic stability and the potential widespread effects if China kept reducing its holdings or increased trade taxes. From the U.S. viewpoint, these diplomatic efforts have clear goals. The government needs to ensure money keeps flowing. That means making sure demand for U.S. government debt remains high. Lower demand would increase borrowing costs, which could destabilize not only government financing, but also interest rates for home loans, business borrowing, and consumer credit. At the same time, the U.S. wants to prevent new economic instability. With international markets nervous, increasing tension with China could reduce confidence in U.S. debt as a secure investment. By urging China, one of the world's biggest foreign holders, to stay involved, the U.S. aims to maintain stability, reassure investors, and keep borrowing costs manageable. Viewed against the background of falling Chinese Treasury ownership and growing worldwide uncertainty, these talks seem less like typical negotiations and more like an urgent request, an effort to secure support before the damage becomes worse. China has been following a careful long-term plan to reduce its reliance on assets held in U.S. dollars. For years, the country depended heavily on U.S. Treasuries as a safe and easy-to-sell investment, but recently it has increasingly spread out its foreign reserves. China now holds a growing amount of non-treasury bonds, investments in other currencies, and physical assets like gold. This spreading of risk allows China to diversify its exposure, strengthen its financial independence, and get ready for potential global economic problems. At the same time, China is dealing with serious domestic economic issues that make owning huge amounts of foreign debt less appealing. The country has a substantial debt load across government, corporate, and local sectors. Its housing market has been struggling for years, with developers defaulting on loans and construction projects halting, creating uncertainty for investors. Meanwhile, the Chinese government is putting in place domestic policies aimed at stabilizing the economy, cutting down on too much debt, and ensuring long-term growth. These actions often require keeping money at home rather than investing heavily in foreign assets like U.S. Treasuries. These domestic pressures, combined with a deliberate strategy to diversify, suggest that China may be unwilling or even unable to act as the ultimate buyer for U.S. debt markets. In other words, the country is no longer in a position, either politically or financially, to guarantee stability by continuing to buy vast quantities of U.S. government bonds. This change reflects a wider trend in global finance. Major players are increasingly prioritizing national economic needs over international duties. The combination of a deliberate shift away from dollar assets and urgent domestic challenges shows why U.S. Treasury markets are entering a time of uncertainty. China's role is changing, and its previous support for U.S. debt can no longer be assumed. As China and other major holders reduce their purchases of U.S. Treasuries, the cost of borrowing for the U.S. government is likely to increase. When returns on Treasuries go up, it starts a chain reaction throughout the entire financial system. Home loan rates climb, making buying a house more expensive for American families. Consumer loans become costlier, affecting car loans, personal credit, and business financing. Companies face higher interest on corporate bonds, potentially slowing investment, hiring, and plans for expansion. Global bond markets could experience significant swings as investors react to these changes. A drop in demand from traditional buyers like China creates uncertainty, causing other investors to reevaluate the safety and stability of U.S. debt. This could lead to ups and downs in bond prices, causing effects that spread to stock markets and other financial tools linked to interest rates. The U.S. dollar's status as the world's main reserve currency could also be threatened. If major holders of treasuries decide to diversify or sell off large amounts, confidence in the dollar may weaken. Countries and organizations that rely on U.S. debt as a stable asset may start moving toward other currencies or investments, further challenging the dollar's global leadership. These changes are not confined to financial markets alone. They have broad international consequences. Investors worldwide may begin to reconsider what counts as a safe asset, moving capital into alternatives such as gold, other government bonds, or different currencies. Trade flows and global investment patterns could be disrupted as countries adjust to higher borrowing costs and financial uncertainty. Businesses that rely on international funding may encounter higher costs, and developing markets in particular could feel the pressure as capital becomes more expensive and unstable. The combined effect of rising U.S. borrowing costs, bond market volatility, and potential shifts in the dollar's role could redefine global financial stability. Investors, governments, and ordinary people alike may feel the impact as economic choices become more costly and markets become less predictable. One possible situation is that the United States manages to find new buyers for its treasuries. These buyers could include other nations, large institutional investors, or government wealth funds seeking safe long-term returns. If demand stabilizes, the Treasury market could recover, keeping interest rates relatively steady. Borrowing costs for the U.S. government would remain manageable, and the broader economy might avoid major problems. Investors and businesses would gain confidence from seeing stability return, and the ripple effects through home loans, credit, and corporate borrowing could be limited. In this scenario, global financial markets would feel relieved, and the United States could keep its economic influence. A second situation involves a further reduction in holdings or a continued refusal by China to participate. If China and other large holders scale back aggressively or quickly sell off large volumes of treasuries, interest rates could jump rapidly. Higher rates would increase borrowing costs across the board, affecting everything from home loans to corporate debt. Consumer spending could decrease. Businesses might delay investments, and government financing would become more expensive. The shock could spread globally as investors reconsider risk and capital flows, causing instability in bond markets, stocks, and currency exchange rates. Countries that rely heavily on U.S. debt as a standard might struggle to find alternatives, increasing the economic strain. A third situation involves a diplomatic or financial agreement between the United States and China. Such a deal could include compromises, concessions, or financial incentives to encourage China to keep buying treasuries or to restore confidence in the market. Friendly nations or other major investors might also be brought in, helping to stabilize demand. These deals could involve changes in trade policy, reductions in import taxes, or coordinated financial planning. If successful, the United States could secure a temporary lifeline, slowing the rise in interest rates and bringing back a sense of predictability. While uncertainty would remain, strategic talks could prevent a full-scale market crisis and signal that the U.S. can manage complex global economic relationships. Each of these situations carries major implications, not only for the United States, but for the world economy. The choices of major holders, the reactions of investors, and the effectiveness of U.S. economic diplomacy will determine the next stage of financial stability, interest rates, and market confidence worldwide. The massive support system that has backed U.S. Treasury markets for decades is diminishing. What once seemed completely secure and reliable, Treasuries seen as the ultimate safe investment, is now under pressure. Foreign buyers, especially China, have reduced their holdings, and global investors are reconsidering the risks. This change shows that even markets considered stable can become vulnerable when trust and confidence begin to waver. The bigger lesson is clear. Global financial stability depends on much more than just numbers on a financial statement. Global politics, strategic decisions, domestic economic pressures, and investor attitude all play vital roles. When major players change direction, it can send effects through the financial system, impacting markets, economies, and ultimately the lives of regular people. Interest rates increase, loans become more expensive, people buying homes face higher mortgage costs, and businesses may pause expansion. Prices for goods and services could rise, and jobs could be affected as economic uncertainty spreads. These developments make it obvious that financial security is linked on a worldwide level. Decisions made by governments and investors in one part of the world can have immediate and noticeable consequences elsewhere. It is not only officials and large institutions who are affected. Everyone who borrows money, invests, or spends in the economy could feel the effects of these changes. We are interested in your views. Do you believe the United States can overcome these challenges, stabilize the Treasury market, and maintain global confidence? Or is this just the start of a deeper, more widespread financial crisis? Your opinion matters because these events, although complicated, ultimately affect all of our lives in ways that are often not visible until they happen. That brings us to the end of today's analysis. We would love to hear from you. Do you think the United States can bounce back, or are we seeing the start of a bigger global financial shift? Share your thoughts in the comments below. If you want more clear, in-depth analysis of worldwide economic events and what they mean for you, make sure to like this video, subscribe to our channel, and click the bell so you never miss an update. Your support helps us keep bringing these insights directly to you.